and financial environment in the first half of 2015, as well as the outlook for the rest of the year. The committee observed that global output recovery remained largely sluggish, although with strong promise in the United States and the euro area. The IMF maintained its growth forecast of 3.5% for 2015 with improved outlook for the advanced economies, but weak performance in the emerging and developing economies. Softening oil prices continue to present improved growth opportunities for advanced economies and oil importing countries, while dampening growth prospects in oil exporting economies. The United States led growth in the advanced economies largely on account of lower energy prices, increased consumer spending, and housing market recovery. The expectations of U.S. monetary policy normalization in the medium term continue to fuel investor expectations. Growth outlook for the U.S. remains steady as inflation stays below the Fed's reserve 2% target. The Bank of Japan continued its accommodative monetary policy stance by injecting 6.7 trillion Japanese yen, approximately $55.83 billion, monthly under its assets purchase program. In the euro area, the Greek debt crisis crystallized into uncertain and difficult negotiations with the tripartite group of creditors and altered the underlying confidence in the survival of Greece in the Eurozone. Meanwhile, the European Central Bank's 61 billion euro monthly assets purchase program continues in an effort to combat the effects of deflation and high unemployment in the peripheral economies. The Bank of England has maintained its £375 billion asset purchase program in the face of downward trend in inflation in most of the surrounding euro area economies. These expansionary policies by the ECB, Bank of Japan, and the Bank of England could moderate the threat of capital reversal posed by the imminent normalization of U.S. monetary policy. Amongst the emerging markets and developing economies, growth is expected to slow considerably, but resume moderately in 2016. Growth in China is projected to slow at 6.3% in 2016 from 6.8% in 2015 due to continued financial market vulnerabilities, decline in productivity, excess capacity, and weakening domestic demand. Growth in the developing economies is expected to remain uneven in the short to medium term, largely reflecting their weak demand, lower commodity prices, and tight financial conditions. Global inflation is expected to remain moderate at 3.5% in 2015, but projected to accelerate to 3.7% in 2016 due to rising downward risks, particularly in the euro area, as well as the tailwinds arising from the sharp drop in oil prices, excess capacity in the advanced economies, and the appreciation of the US dollar. Output growth in the first half of 2015 continued to accelerate compared with the level as at December 2014, mainly as a result of softening oil prices. According to the National Bureau of Statistics, growth in the real GDP declined to 3.94% in the first quarter of 2015 from 5.94% and 6.21% in the preceding quarters and corresponding period of 2014, respectively. Real GDP growth is projected at 5.54% for fiscal year of 2015, reflecting a $68 basis points decrease compared with 6.22% in 2014. At 5.59%, the non-oil sector continues to be the main driver of output growth in the first quarter of 2015 at 5.59%, with the leading growth sectors being construction, services, agriculture, and trade, which grew by 11.17, 6.85, 4.70, and 4.47% respectively. On the other hand, the oil and gas sector declined by 8.15% in contrast to the modest growth of 1.2% achieved in the last quarter of 2014. While the successful conduct of the 2015 general elections was a stabilizing factor for the economy, persistent scarcity of fuel products as well as slow improvements in electricity supply could be a drag on output growth in the near term. The committee underscored the need for the intensification of various ongoing initiatives to diversify the economy away from oil and expand the base from foreign exchange for foreign exchange receipts. The committee was concerned about the gradual but steady increase in headline inflation up to June 2015 and noted that this reflected a rise in both the core and food components of inflation. Core inflation rose to 8.4% in June from 8.3% in May, and food inflation increased from 10% from 9.8% over the same period. The committee observed that the uptick in year-to-date inflation rate was traceable to transient factors such as energy, arising from scarcity of petroleum products around the country, poor electricity supply, and increased demand for transportation and food from the build-up to the general elections and the ensuing Easter and Salah celebrations. The committee reiterated its commitment to price stability and observed that monetary policy would remain tight because of the high liquidity in the system. It, however, noted that the drivers of the current upward inflationary spiral were of a transient nature and mostly outside the direct control of monetary policy. Consequently, the opportunity for further policy maneuver remains largely constrained in the absence of supporting fiscal measures. It therefore urged the coordination of monetary, fiscal, and structural policies to stimulate output growth and stabilize the exchange rate. Money, trade, credit, and financial markets development. Broad money supply declined by 0.61% in June 2015, below the level at the end of December 2014. The modest decline in monetary supply reflected the decreases in the net foreign assets of 16.15% and other assets of 21.40%. Net domestic credit, however, grew by 13.45%. Analyzed NDC grew by 27.90% over the end of 2014 level, but essentially within the provisional benchmark of 29.3% for fiscal year of 2015. The growth in aggregate credit was attributable to growth in federal government borrowing, which reached 40.81% in June 2015. During the period under review, money market interest rates were relatively volatile owing to fluctuations in banking system liquidity. Average interbank call and open buyback rates opened at 6.55 and 6.45% on 1st of July 2015 and closed at 26.51 and 21% respectively on July 23, 2015. Average interbank call and OBB rates for the period were 9.83 and 10.23% respectively. The committee noted a bearish trend in the equities segment of the capital market during the period. The all-share index declined slightly by 1.66% from 31,744.82 on March 31st, 2015 to 31,216.72 on July the 23rd, 2015. Similarly, market capitalization decreased by 0.37% from 10.72 trillion to 10.68 trillion during the same period. Relative to the end of December 2014, the market indices decreased by 9.9 and 6.9% respectively. The slight decline in share prices year to date was largely due to subdued sentiment preceding the general elections, as well as the lingering effects of the falling oil prices. The external sector. The average Naira exchange rate was relatively stable at interbank segment, but slightly volatile in the Bureau de change segment during the review period. The exchange rate at the interbank market opened at 197 Naira to the dollar and closed at 197 Naira to the dollar, with a daily average of 197 Naira to the dollar between July 21 and July 23rd, 2015. The relatively stable exchange rate in the interbank segment can be attributed to the effects of some recent demand management measures. Gross official reserves increased from $28.57 billion at the end of May of 2015 to $31.53 billion as at 23rd July 2015, reflecting the blockage of leakages as well as the bank's management policies. Committee was concerned about the trends in key macroeconomic indices in the first half of 2015. The committee acknowledged the absence of easy choices in the circumstance, but monetary policy alone remains handicapped and will require urgent complementary fiscal policies to define the path of growth and create the basis for stabilization. Consequently, the impact of the hard choices to be made by monetary policy could remain largely limited under the prevailing circumstances. On the external front, the adverse effect of protracted decline in global crude oil prices on the fiscal position of government is becoming increasingly obvious. The expected policy normalization in the U.S. could accentuate capital flow reversals from emerging and developing economies and further tighten global monetary conditions, thus exerting greater pressure on exchange rates in those countries. Given the choice between controlling either quantity or price, the limitation on choosing quantity were evident, necessitating the need to employ some flexibility around price while allowing current demand management measures to fully work their way through the economy. Committee, however, noted that financial system stability considerations place key limitations on the extent of considering price flexibility, creating a compelling need to balance measures to address the current vulnerabilities. On inflation, committee stressed that some of the drivers of current pressure on consumer prices were transient and outside the direct influence of monetary policy. Pressure on food prices is expected to gradually wane as the planting season gives way to harvest in the month ahead. Any resolution of fuel scarcity will dampen transportation costs and improve food distribution across the country, while improvements in electricity supply could steady output at lower costs. Overall, the committee expressed optimism that business confidence would continue to improve as the government continues to unfold its economic plans. In addition, some of the reassuring measures of the administration, including efforts aimed at resolving fiscal challenges at the sub-national levels and the fight against corruption and improving the business environment would unlock the inflow of foreign direct investment. Committee also underscored the imperative of growing and protecting the country's foreign reserves and building fiscal buffers in the process of strengthening confidence in the economy, which is essential for promoting growth and stability. Committee's decisions. In consideration of the underlying fundamentals of the economy, the evolving international economic environment, developments in oil prices, as well as the need to allow for unveiling of the economic agenda of the federal government, Committee decided by a vote of 8-4 to retain the monetary policy rate at its current level of 13%, by a unanimous vote to retain the CRR at 31%, and by a vote to retain the CRR at 31%, and a vote of 8-4 not to remunerate the CRR. Further, one member voted to increase the MPR by 50 basis points to 13.5%, and 3 members by 100 basis points to 14%. Overall, MPC voted to hold its position. In summary, the MPC voted 1. To retain the MPR at 13% with a corridor of plus or minus 200 basis points across the midpoint. 2. Retain CRR at 31%. And 3. To retain the symmetric corridor of 200 basis points around the MPR. I thank you for listening.
Thank you, Mr. Godwin. Distinguished ladies and gentlemen, we have had the presentation of the communique. I know there will be a few questions. Just come up here, tell us your name, where you work, and then your question. Please make it as snappy as possible. Amen.
Good afternoon, Mr. Governor. My name is Emmanuel. I work with AIG. My first question has to do with the MPR decision, the MPC decision. Of course, for some time now, it's the general belief that MPC's decisions do not usually consider the banks, because the decisions, the MPR, even the MPR at 13% with a symmetric corridor of 200 basis points, is hurting the banks, even from different analysis. So when in the nearest future do you think that the MPC will begin to consider the banks? And most likely, because when it hurts the banks, it hurts most the customers. When do you think that they will begin to consider the banks? My second question is on the foreign exchange, which is everybody's wahala right now. Because the Naira seems to be stable. The interbank market has noted in your speech at 197 Naira. But in the parallel market, it's gone as far as 244 Naira. Is the CBN taking measures to, because most people don't buy through the interbank market, they buy through the parallel market. And the effect on the economy, on the common man, is on the parallel market. So what is the CBN doing to put a stop to this fall of the Naira in the parallel market? Thank you.
Thank you.
Good afternoon. My name is Ralia Tadeneko from Classic FM at 97.3 and the Beat 99.9 FM. My question is actually a little bit for very easy.
Has to be focused. I'm sorry. We can take that up some other time.
My name is Samuel Chio when I work for the Sun newspaper. Sir, you made mention of strategies to build fiscal buffers, and a lot of people have expressed concern about the possibility of building these buffers in the event that Iran has just returned to the international oil market. With this scenario, how possible can these buffers be built? Secondly, I want to ask a question on issue of the request by states for bailout. And while you were away, there was this clamor that they needed to get some ideas as to what you are going to do to ensure that states get some lifeline to run their business. Now, in the event of this happening, one would want to know what measures are you putting in place to ensure to manage the inflationary impact of such injections into the state finances. That's the question I want to find out.
Thank you.
Good afternoon. My name is Uriyo Machuwa for Business Day newspaper. Governor, this talks around devaluing the naira, seems to be coming up again. Is it what the CBN is looking at? Are there plans to devalue the naira again in the short to medium term? One. Then, secondly, you did just tell us that you've been able to, all our foreign reserves, have been able to accrue or begin to accrue again because of the leakages. You've been able to plug and all of that. What do you mean by that? What leakages? How were you able to get to that? Then on the BDCs, we are happy that we are beginning to see the CBN roll out policies that would ensure or that will put more checks on the activities of the power market, will really change, what they do there. Now you have told them to align their transactions from August 1 using the BVN, and we are just wondering, how you're going to do that, or the structures that the CBN has put in place.
Come back again on that second question.
On the BDCs.
You said
BDCs will change.
Your first question was issue of leakages. Yeah.
That's the second one. Then the first one, devaluing the naira. That was the first one. Second one, leakages. Then third one on the BDCs and the activities. You have asked them to align their activities, their transactions using the BVN that just or that is still on. And we're wondering how you are able, or the structures that you've put in place to ensure that works, considering the fact that their transactions are not as structured as what goes on in the interbank market.
Yes.
Thank you very much, the 37th Governor of the Nigerian Federation. My name is Matthias Okwe. I work for the Guardian newspapers. So, you mentioned as one of the drivers of inflation in Nigeria, you mentioned the fuel import, the scarcity and all that, the attendant things. I'm just wondering if the CBN is thinking of intervening in the refineries resuscitation, as we have done in other key areas like power and things like that. Is CBN really thinking in this direction to make sure that we address that issue, to make sure that we have solved that solution, so we can no longer be importing fuel? Thank you, Mr. Governor.
Thank you. Thank you very much. Nancy?
Thank you, Mr. Governor. I'm Nancy. I anchor the Money Show. Governor, I just want you to perhaps say some things on the last briefing we had, was in June, when you talked about the access to FX to some items, about 41 items. A lot of people have praised the CBN's decision on that. Some also have complained and are worried. Is the central bank going to review that, or will it still be as it is? Because I do know some groups, I think the Manufacturers Association of Nigeria has also spoken. What's the CBN stance on this? Thank you.
Thank you. That's the last question. Mr. Governor.
Thank you very much. The first question dwelled on MPC decisions. It says that MPC decisions do not consider the banks because CRR is supporting the banks. Well, help us apologize to the banks. The point is that we have our own work to do. as regulators. We have our own indices that we monitor. We have money supply and liquidity to monitor in the system. And depending on the level of liquidity that we find in the system and our own goals about how to control, how to achieve our price and monetary stability objectives, we didn't have any choice but to adopt those measures. And like we said, at this time, the central bank continues to maintain a tight stance. From the way you saw the votes, most people still voted that we should maintain the position. Minority feels, one person like you heard said, let us even reduce the CRR, while some say, look, let us even compensate them. We will continue to review what's happening in the market, and at some point in time, the MPC, where are 12 distinguished members, each having their own independent votes and voices, will take a position. And I'm sure maybe in the course of time, maybe at the next country policy meeting, depending on data that is made available to MPC members, it might be possible at that time, and depending also on what is happening in the macro environment, to begin to look at easy bet. And I'm not saying that is the position. We will review the situation as we get there. The second question dwelt on the parallel market. Let me say that I do not agree, I strongly disagree when you say that most people patronize BDC. More than 95% of transactions that take place in the I use the word financial system that involves buying or procuring foreign exchange take place at the bank or interbank market. Indeed, let me underscore the fact that Nigeria appears to be the only country in the world today where the central bank is supporting the BDC activities. And I am saying again that I don't know what the direction will be, whether we will continue to or not. But the point we should note is that data available to Central Bank of Nigeria shows that most of the transactions that take place at the parallel market windows, rather than being for just retail trade, are people doing transactions for what we term as illicit business. And for that reason, I continue to wonder why people will continue to use the BDC rate, which constitutes an infinitesimal percentage of volume of transactions in the foreign exchange market, as a basis to asking us to determine exchange rate. We will not, we cannot, because we do not consider that market as a major market in the foreign exchange market. Radiant asked a question about strategies to build fiscal buffers. Well, I think it is always in the interest of every country to build fiscal buffers at times when we can say times of plenty, to prepare you for times of scarcity. Unfortunately, we are in times of scarcity, and I must confess to you that getting to build fiscal buffers, even though it's a target or an objective that we would like to pursue, is going to be difficult, but we will collaborate and work with the fiscal authorities to see how we can move in this direction. State bailout. It's important for me at this stage to mention or reiterate, if some of you have heard it, that a situation where there had been almost close to a 50% decline in revenue in crude prices, which correspondingly has led to more than 50% decline in our revenues from oil, and by extension has also resulted in a corresponding substantial drastic decline in revenues that state governments receive from the federal purse. Naturally, what you will find is that some of the states will get into the kind of situations that they get into today. So the point is that does a laborer deserve his wage? And my answer is yes, and most of you will agree that a laborer truly deserves his wage. And it is in consonance with that we thought that it is unfair for some people to work and not get paid after 30 days. Indeed, some of them have extended to as high as 5 to 6 months. We feel so sympathetic to their cause, and that is the reason that in discussions at the National Economic Council, and it was decided that the central bank should step in as the lender of last resort to come to the aid. It is not grant, it is going to be loans. The Central Bank of Nigeria, as well as the banks, as well and the commercial banks, will also be holding discussions with the commercial banks as to how to restructure their expenditure or revenue profiles, encourage more of them to diversify into internally generated revenues so as to boost their revenue base so as to eventually meet their own obligations. We are working on this, and in the course of time, some more details will be unfolded. You talked about the inflationary impact. I think that I agree to some extent when you talk about inflationary impact. But what is important is this, that this is money that should in the first instance have been in circulation, because people would normally expect that people to have earned their salaries. Not earning their salaries, I think, is something that earning their salaries at this time is what should override every consideration while we think of how to moderate its inflationary impact. The valuation, any plans? The point is that we had done a depreciation of a currency by almost about 22%, from 155 to 197 that it is today. And like we had addressed earlier, we cannot continue to adopt an indeterminate depreciation of our currency because of its impact on our people, given that this is a heavily import-dependent economy. So my answer is that the Naira is appropriately priced at this time, and we continue to monitor the situations, and in the course of time, if there is any need to change our positions, we would let you know. The issue of leakages. Yes, it is true that the president, based on pressures and based on his insistence that leakages must be blocked, there have been serious attempts to block leakages both in the Naira and in dollar. Some funds have been trapped in banks, and that is the reason there is a vigorous effort to ensure that we all embrace the Treasury single account, where all revenues collected must come to the center. And after the month, revenues will have come to the center based on the budget that has been approved for any agency of government, then whatever is due to them to meet their operational expenses will be given. But the first point is that all revenues must come to the center. In the course of this, I would like to confirm here there have been leakages that have been blocked, and as a result, you've seen some funds trapped in some areas now coming into the center, and hence part of the reasons you've seen the reserves build up. BDCs and activities regarding the BVN. My response to that is that all bank customers are expected to have a bank verification number. And I expect that the BDCs themselves will be dealing with people, because they are bank customers, they will be dealing with people who have bank verification numbers. It is important that we begin to embrace best practices, where transactions that take place in the banking or financial system can be monitored, but not that people just walk across the street and begin to buy or procure foreign exchange without proper identification. This is our own way of ensuring that people who patronize BDCs for retail foreign exchange transactions that are authorized must provide their bank verification number. That is what we're insisting, and we want to appeal to all those who are concerned to please assist us by adhering to this directive. whether CBN is going to be intervening in the refineries. Let me confirm that we've held, the Central Bank and the NNPC have held a couple of meetings, and I'm aware that I think Warri and Port Harcourt refineries have started to produce refined petroleum products. We are expecting that in the month of August, Kaduna refinery will also begin refining of petroleum products, and hopefully as they ramp up production, this will hopefully get to the level that is anticipated of almost close to about 19 to 20 million liters per day, and hopefully, not hopefully, certainly, given that we project or is being forecast that daily consumption of PMS in Nigeria is almost about 30 million liters, our own interest as Central Bank is that by this act alone, we are going to see a drastic reduction in the importation of petroleum products, which will ultimately help our reserve position and help us in our mandate, our objective to strengthen the exchange rate. Lastly, on the issue of access to foreign exchange by 41 items that have been excluded, let me respond by saying that the Central Bank of Nigeria's one of its major mandates is to build reserves and maintain or achieve strong exchange rate for the country. And I have always maintained since I became the governor of Central Bank of Nigeria that Monetary Policy Committee will as much as possible take decisions not only that help in achieving macroeconomic stability, but our decisions we take must be those decisions that will impact positively in the lives of our people. If our decisions are those that will impact positively in the lives of our people, it therefore means that we need to be able to make decisions that will create jobs. We need to make decisions that will resuscitate our dead and moribund industries. We need to take decisions that will ultimately lead to economic growth and development in Nigeria. I must thank those Nigerians or those who have called or written us to thank us for taking these decisions. These are hard times where there are limited resources. There is therefore a need for all of us to work with the government and the Central Bank of Nigeria to see how we can begin to curb some of our excesses. We are all witnesses to the fact that in the late 50s or in the 60s, Nigeria used to be, in fact, Nigeria had controlled 40% market share in the production and export of palm oil in the world. But things reversed. Those days, we will see our uncles, our brothers, our fathers, our brothers who own 50 palm plantation, or 100 palm trees, or even 200 palm trees. They look forward to the time when they will go to their palms when it is ripe and cut those palm trees. They convert those palm fruits into palm oil. And they crack the palm nuts and turn them into palm nuts. Young men who are craving for jobs come from the cities and they buy those palm oil from them in jerry cans. They also buy those palm kernels which they take to the cities. And that's where some of us who are currently developing the nostalgic feeling that this no longer happens are saying that we need to return back. Today, Nigeria imports almost close to 1 million metric tons of palm oil, when at the time in the 50s and 60s, we were producing palm oil for our own domestic consumption and also for export. At a time when resources are lean, I would like to appeal to Nigerians that this is time for us to go back to those days, where jobs will be created for our rural communities, and our mothers, our fathers, our uncles in the rural areas can begin to earn money for them to send their children to school and not export jobs outside the country. That is the message. Today we are aware, or let me go back, in the 80s and early 90s, if you went to Kano and Kaduna and some other parts of the north, cotton was being produced. Cotton will be ginned and turned into yarn. These yarns will be used in the textile industries, not only just in Kano, Kaduna, and northern part of the country, but also in the southern part of the country. And for those of us who know Lagos very well, between Anthony and Mile 2, the left and the right side of Apapa Oshodi Express Road used to be dominated by textile industries. We had Afprint. In Igomo, we had President Industries. President Industries at Igomo used to produce the best Guinea brocades in this country in the early 90s. Today, President Industries premises at Igomo have been turned into a warehouse where we store imported tiles and imported granite. You can go there. It's there on the Jora Causeway. What has Afprint become today? Afprint has been turned into a warehouse that receives imported rice, imported textile, and imported palm oil. GDM Textile is a warehouse that has been turned into a warehouse that receives imported rice, imported textile, imported oil. That is the way what we have done to our country by exporting jobs to other countries. I think it is time for us to rethink and come back to terms with the fact that we need to create jobs for our people. I'd like to seize this opportunity to please appeal to those of us, the manufacturers or Lagos Chamber of Commerce, who are willing to engage them. The Central Bank of Nigeria, in collaboration with the Nigerian Deposit Money Bank, will work with them, assist them, continue to act as financial catalysts that will help these institutions and these industries to come back to life, create jobs for our people, improve economic growth, and contribute to our GDP positively. Thank you very much.
Thank you. Thank you, Mr. Governor. I think that's the end.